Hello, and welcome back to Scale to Exit with Alejandra Santos on another amazing episode. And I know you missed me last week. I know you did because I was out sick, but we're back this week, hot, flaming, like I would say, ready to rock and roll. And we're bringing an amazing guest into the podcast. But before we're diving into the episode, let me just say again, thank you so much for everybody that continues to show up to Scale to Exit. Thank you, thank you, thank you. And for everybody that's new to Scale to Exit, welcome, welcome, welcome. We love to have you here. Scale to Exit is the platform that I created to help educate and bring awareness to entrepreneurs and seasoned business owners. No matter where you are in your business journey, you could be building a startup or you could be scaling an amazing business by now. It does not matter. Scale to Exit is to help you understand how to scale for an exit. Building a business is very different than building one for an exit. And over about 16 years that I have going on in my experience, I've learned that most entrepreneurs and business owners are very good at building the business part, but they're not very good at selling the business part. So that's why we're here. And Scale to Exit brings to you guests, amazing guests, like the one that we're going to have a conversation with today. It brings you guests that have exited their business. It brings you investors, VCs, PE firms, M&A advisors, brokers. I mean, you name it. We're here all coming together with one mission to help you bridge the gap between a business and a sellable asset. So that's what Scale to Exit is. So welcome, welcome, welcome. And this episode comes with great nuggets of information. So like if you ever wondered, right, when to sell and how to keep your team through an acquisition, which is very important, or why most value add VCs don't add actually value, you're going to love this episode. So my guest for this one is Justin Gray. He's a serial entrepreneur that now turned VC. We loved an entrepreneur that turns into VC, who grew LeadMD from a bedroom idea to $17 million in revenue and executed a strategic exit at the top of the market. So we're going to talk about bootstrapping versus funding, building predictability so your business is truly sellable, using equity to retain A players, which is a strategy that you should definitely tune into, and why his operator-immersive model is designed for more consistent outcomes. Now, think about singles, doubles, and triples instead of lottery tickets. I've always said VC is broken because chasing for a unicorn is just all cuckoo puffs. So he's actually creating impact in the VC industry, which I love. If you're building to scale or scaling for an exit, this is your masterclass. Now remember to please share, like, subscribe to the platform of choice. Your support really means a lot. Maybe one of your friends that's building a business would find this very valuable. So please make sure that you share, subscribe, and like. And now I'm going to go ahead and bring Justin Gray into the podcast. So I will see you on the other side.
Yeah, well, first, Alejandra, thanks for having me. Great to come on and hopefully provide some value here. So what led me into this world of entrepreneurship and really like startups and entrepreneurship, entrepreneurialism was not like the glorified sexy thing that it is today when I was getting out of school. Like an entrepreneur was basically someone who did something in their, worked out their garage, probably had no revenue, no employees. It wasn't that, a glorified term. And so I kind of went down the very traditional path. I went to school at here in Arizona, U of A, for business and marketing. Graduated in that major and immediately got a job in marketing that I hated. Got a couple, moved up the quote unquote career ladder after that, and then kind of stumbled onto, what we would call these days a startup. It was a fintech startup in the payment space, and really felt like, wow, this is where these people have been hiding. Like, just I think the fundamental thing about startups that I gravitate towards, and really I have nowhere else to gravitate. Oh, no other place to gravitate to because of this, which is, do anything. If you can do something, do it, right? Like there are no barriers, there's no bureaucracy, no red tape. You're really looking for like who has the skill set and who's willing to jump in and get it done. And that's kind of what I had always been trying to do in my career. And like that was met with quite a bit of resistance in terms of like, no, you do this thing. And I just love the breadth of the ability, the breadth of ability to hop in and say like, hey, this is something I think I can make better and I'm going to go and do that. And startups kind of provided me that leeway to exercise that curiosity and really just kind of stretch my skill set and operate across a business. So I fell in love immediately and was fortunate enough to help that business scale to just above 250 million in valuation. Took my sweat equity that I had acquired at that point and went out and started a lot of businesses. No, that's actually the a business called, which is now called Billing Tree. It was called EPP at the time, but that was my last like stint as an employee. I did start LeadMD on the heels of that, and based on a lot of the insights that I got during that last kind of employee journey. Hmm. Yeah, professional services business. Yep. Sure. So yeah, actually, and it bleeds back into kind of the Billing Tree days. So I was fortunate enough to stumble onto what is now called marketing automation. At the time, it was very nascent. It was, a couple organizations. I think, Eloqua had a little bit of traction. Marketo was like a seven-person company. HubSpot was not even like really on the radar at that point. This is 2006. And so I stumbled upon this tool and I immediately thought, wow, like that's what we've been trying to do with all these kind of disparate platforms in a very manual way. And so I was like, this is awesome. And so I ended up buying it. I was Marketo's somewhere between 10th and 20th client. And the experience that I had there was really interesting because it was such a new piece of technology. No one knew how to run it. And the enablement was just really poor. It was like whoever purchased that week, you got on these big group webinars, not I say big, like probably 5 to 10 of the companies that had also purchased in the recent history. You got on this group support session. They walked you through like literally like the nuts and bolts of how to build things in the platform. And you got like 2 or 3 of those sessions and you were on your own. So I was running a team, I was running marketing and sales at that time. So I had to, more on the marketing side, I had to like train that team on not only what to do, but why to do it. Because again, like things like, I won't go too deep into this rabbit hole, but things like nurturing and lead scoring and, variable content and engagement, those just weren't really things that existed previously. Like, yeah, you wanted to send emails to your house list or your best buyers, but you did that all manually. Like you couldn't score things based on, digital movements and so on. So it was less about, I mean, enablement and training around the platform itself was very necessary, but more so, how do we do this? And so when I was fortunate enough to exit uh, my position in that business, immediately I knew like, well, this is, this is going to catch on. This is a platform that's got some legs to it. And again, I truly believe at least half of entrepreneurship is luck. A couple of folks had reached out because they had seen what I had done at Billingtree, and they said like, what were you, how were you doing that stuff? And I said, well, these are the platforms I had. I can implement them for you. I can, bring your team up to speed and teach them how to really leverage these tools. And that, very, in a very lucky manner, I stumbled onto what ultimately became LeadMD. which was, eventually a go-to-market consultancy. In the early days, we were squarely a marketing automation consultancy. And so we started implementing those tools and enabling teams, eventually bringing on retainer products where we would actually run or augment our clients' teams. And so, we just kind of built services out from that, special squishy center. But, it is clear that was, an inflection point within the market. That was a technology that was going to be around. I think we're seeing the same thing these days with AI, which is great. But it was just, very much a market need that propelled us into that area. Hmm. Very much so. Yeah, I've started. I still consider Billingtree one of my kind of entrepreneurial journeys, but I've started 4 businesses on my own. They've all been bootstrapped, and they've all exited at this point. Hmm. Yeah, I think fundamentally everyone should bootstrap a business at some point in their life, and hopefully very early on, because I think it just informs the way that you think about business, and certainly the way that you operate. So, I mean, bootstrapping, as I'm sure we could all assume, is very focused on, can I feed myself that day? Like, is there a bottom line to this organization? It informs the decisions that you make. I think the more that you can combine those two mentalities, actually, like the mentality of, yeah, money's not free. I'm going to be a good steward of capital. At the same time, growth requires risk. It requires spend. And I see so many folks that, are bootstrapped to kind of go down that path, and they stay in that mentality, meaning I'm going to optimize the bottom line. I want to take home the most profit that I can. And they don't grow. They become lifestyle businesses. And, that's very much a segment out there. If people are doing that intentionally, more power to them. I just never really identified with that mindset. And so, we took a lot of risks. Some worked out, some didn't work out. The ones that, worked out, fortunately worked out really big. But I think you've got to combine those two mindsets to answer your question. Like, you have to be cognizant that at the end of the day, a business has a top and a bottom line. And if you're just going to proceed with a top line forever, I find it really difficult to generate real enterprise value with that mindset. And I think you're seeing a lot of that. We've all been through 2021 at this point, but like that pushback on efficiency and revenue per head and bottom line profitability, like eventually that has to be there in a business. That's what we're all now investing in the potential for, and hopefully starting out to grow based upon the promise of. Hmm. Which, yeah.
Now things are different, like you said. Right now things are now those funds need at least some money to see in the top line revenue, some recurring streams coming in.
Most of them, yeah. I mean, like obviously, like there's always going to be, and you're seeing it with AI, like the investment in really, non-existent revenue lines for the potential payoff. But obviously, there's going to be downsides to that. Like you're going to be diluted in most cases if you don't have. If this isn't your third or fourth business, we could all talk about the Adam Newmans of the world, but for most people, it's going to mean giving up a lot, and the risk is incredibly high on both sides of the aisle. So yes, like even seed stage investing where we play, like we don't start looking at companies until they at least have 500K in ARR, and I see that really becoming more, to your point, more prevalent within the VC space, where you want to see traction, you want to see market proof, and even then, that's very early stage, and the subsequent growth is going to be critical.
Yes, and the reason why I bring that up is because I've seen that, like the change, right, in investment altogether. And I also, because I work with both owners,
Hmm.
but the owners here that Bootstrap mainly are on different industries. They're more blue collared. They're not as, sexy as the ones that usually get funding, right, from VCs, which is the tech, the AI, the e-commerce side. So why can we not focus more on the which they have
Well,
traction, revenue, they
yeah,
have, you know.
I think we can. I mean, even our thesis is vertical SaaS. So, like, yes, we're still working with technology, but we're talking about fleet maintenance, and we're talking about healthcare, and we're talking about construction. The very verticalized approaches to SaaS, and I truly believe that's where the value in AI ultimately resides. However, I think you're seeing that, if you look at private equity as a canary in a coal mine, like those, typically less sexy blue collar businesses, like those are being looked at as revenue lines these days. And the same thing that's creating value in those businesses is the same thing that is now, like, people are focusing on technology and saying you have to have this, which is efficiency. It's really, a strategic advantage within the market. You're using technology to scale that organization. So I do think that there's more interest across the board than there ever has been. There's always going to be, the B2B SaaS and B2C SaaS AI, models and softwares of the world, which get a lot of attention. But, to see what's happening in car washes or pool service or landscape maintenance, like, we're bundling those things up and we're selling them as portfolios. So, like, if you can create a recurring revenue line, I think you can create a great business regardless of where you're operating.
Where you're operating. I love that you said that. Okay, going back to the professional service and marketing that you created, how did you know that that was the right time to exit your business?
Oh, for the exit, I think, I said when I started out, I never want to have more than 50 employees, and we did. I think we were at 64, 65 at the time, by the time we exited. I was just spending the majority of my day dealing with remediation. And for me, that is, again, like harkening back to what is not fun for me in terms of when I was an employee and so on. Having to just deal with, conflict resolution all day. And then, like, we had awesome people. And this is even with awesome people, but, like, you just get to a critical mass where the problem sets are going to be different. It's not going to be, fundamentally, how do we grow and scale this company any longer? How do we market it? It's going to be, how do I keep these people in the seat? And services is just an incredibly difficult people to get folks, to view as a tenured opportunity, because the better you do, the more work you get. And every time that bell rings for a new logo that's been sold or a new project that's been sold, someone has to pivot their chair and deliver on that project. So it just became a lot of decimal pushing. It became a lot of, again, managing more on the human resource side of the house, which, started out fun and just got, a bit cumbersome and less attractive. So because however, I would not have gone down the exit path if our performance had not been there. COVID for us was a massive amplifier, and we were already on a very, very hot streak. So, we had 4 or 5 years of, software type growth and with a bootstrap bottom line. So I think we were averaging around 28, 29% EBITDA in that business. I mean, we had an 82% top line, in terms of gross margin. So it was just a very, and that's what the business was designed to be. It was a very KPI optimized business across the board from an operational process. So, like, all the pieces were there. The growth was phenomenal. What was happening in M&A was definitely, like, right time, right place. We basically exited at the top of the market. And so the ingredients were there, and we had a very specific set of criteria where we said, like, hey, I don't want to shop this to 100 organizations. Like, let's make a very short list. We came up with a list of 10 orgs that we would consider selling to. And we, got offers from 4 folks on that list. We went to diligence with 2 of them and, ultimately made the decision. But it just felt like it was, it was less about, like, I can't predict today because I love being able to walk in and not know what's going on that today. It became a bit more repeatable, and I really love, like, the 1 to 10 journey, quite frankly. And so just I'd say all the ingredients were there, but I wouldn't have considered it if I was still waking up every day and having 100% fire in the belly type of a situation.
So it was a very emotional then, I guess, because you started
Certainly.
like from scratch, from the bottom, all the way to this level, and then it started becoming too corporate for you, right?
Yeah, just too logistic heavy, I would say.
Yeah. So in its exit like this, so you did a strategic exit to a
Mhm.
competitor, imagine? Okay. So
Well,
you
it was less a competitor, more like, someone that specialized in like the Salesforce stack. And of course we were, Adobe by that point because Marketo had been acquired by Adobe. So they were, as PE firms do, they were PE backed, so they were putting together a platform and bringing in, other organizations. Strangely, we were pretty much the same size as the platform organization, so that led to a whole different set of challenges. But yeah, it was definitely a strategic exit to private equity, based on a nearest neighbor type of organization.
So in those kinds of exits, the hardest thing to transfer is the team.
Hmm.
How, how did you manage to transfer all of these employees into this new arm, this new home?
Yeah, so I should probably put out a few qualifiers. So number one, like a services business, I had never run a services business before. I'd always been in technology and really payments as well. And I started other businesses which were, along those same lines, building software, building payment solutions, so on and so forth. And services was something that was not only new to me, but came with it a really interesting complexity, which is that people are your product. And that is, unless you've run a services business, I don't know that anyone could really understand the full nuance of that sentence, but it changed my perspective on building businesses and what was really important within them. Like within the first couple years of LeadMD, I became very focused on providing upward mobility to our employees in exchange for the hard work that they were doing. So I should say, by the time we exited, 50% of that company was owned by our employees and everyone had equity. So, that was the tool that we used to try to combat what is the very typical consulting cycle of I'm going to step in, I'm going to learn a lot of new things, and I'm probably going to step out of the org in 2 to 3 years. And so we had folks that had been there, a decade when we exited. So, pretty much the entire journey. So we create a lot of that, just retention and goodwill through equity. It doesn't work when someone doesn't value or doesn't look for equity as a compensation component, which is another thing that I learned. But most people do. Some people want to optimize for take home, and that's fine. Like we tried to serve that master as well. Upon exit, I treated our employees the exact way, and this was what's called a change of control bonus program, which basically means like you have to be present to win. It's not stock. You're granted units. At the beginning, we had a whole system on how units were granted for a role and how you could earn more over time. And then, at the time of liquidity, or, I think our agreement was like a 75% ownership change or greater, then everyone is granted those shares. But they also performed in line with my buyout nuances, which I was fortunate not to have a tail, not to have an earnout. Like it was a lump sum cash payment, but I chose to put really for these purposes, for the employee retention purpose, I chose to put about, I think it worked out to be 12% of my buyout back into the new organization. And so I precipitated that down to everyone. So everyone rolled over 12% and they took the lion's share off the table. And so that's how, and this was something that we did voluntarily, but I knew that in order to retain our customers, retain the methods that we were using a lot of systems from a software as well as an operational process perspective to where we were delivering like best in class revenue, best in class profitability. And obviously that made us very attractive from the acquisition standpoint. But we needed to keep the people around because, back to my initial point, like a people based business walks out the door every single day, and you better have something pretty special to get them to return. And so that's ultimately what we devised. And it worked it worked to the extent that it needed to. I think at some point culture is going to take over. So we ran the two businesses fairly separately for a year. And that was, I'd categorize that under like good to fairly good or good to very good. And then as soon as we combine them, there's just a lot of fallout that happens from true, integration of process and everything that goes with that. And so I think the average tenure there, we didn't lose many people within the first year, but they lost a lot of people from, start of year two on, including myself. I had an employment contract, but I had no, required stay period or anything like that. And I chose to step out just because, I'm just not good as an employee, as I think we've detailed already. But, when things stopped being special, a lot of people left. And, so the equity rollover worked to a certain extent. I think it worked to what it needed to. But after a while, like you've got to fulfill on that promise. And I think the acquiring org, learned that.
I just love everything that you said. I mean, service companies should do this more often because they have such a high revolving door for
Hmm.
talent, and that is one of the areas that they suffer the most. Because I own a consulting company, you owned one, and you know for a fact that somebody leaves, you have to train them again, hire them again. That's a huge
Incredibly
cost.
expensive. Yeah.
Yeah, huge cost. So you figure it out. You said, I'm going to give you guys equity, and as you continue to perform, give you more and more, incentivize you to stay here, which work until they actually you gave the company away and
Yep.
they stay longer. I
Yeah.
mean, that was most of the times though. Most of the people just leave right away. So that was a good strategy that you did. And
Yeah, I think it was ultimately a success. But to your point, like and whether your services or any other sort of product or that you're selling, like I think finding out the fundamental there that people should take away is number one, if you can align company wins to individuals wins, like you're winning across every board that matters. Number two, if you can really show people that like there is an exchange of value here, and I respect what you do, and when you do something that's great, again, it's aligned to the organization, and you're going to get more of that. But that mutual, what I call joint value or hyper value exchange is just so critical to any business. And I wish every organization figured out what that was that motivated their people and aligned incentives to that, rather than kind of rolling out blanket type programs or not even bringing equity to the conversation.
yeah, I agree with you 100%. That's the reason why I left my previous role, right, as an employee, and I decided to make a company that is competing with them now, right,
Hmm.
because they didn't give me equity, which I
Yep.
felt very. Yeah. So in the same company, your exit, I know it was emotional for you. Why was this one emotional compared to the other ones you've done?
Well, I think there's a lot tied to what we already talked about in terms of like this is a people-based business, and like you are going into battle every day with those same people. There's no like product that's like, oh, I wonder if the product's going to perform or not, and if it doesn't, like you blame something, right? Like servers were down, product team didn't know what they're doing, engineers screwed up. Like no, this is like our minds that we are marketing and selling and delivering every single day. So I think that in and of itself is highly emotional. Like when we announced it, I think every single one of us was in tears but there's another component as well, because that was my last business. And so I think there's something that people don't talk about enough in terms of identity, which is when I'm not waking up and going to an office for a company that I'm building, what am I at that point? And that's a whole different question, and something that I had to deal with. I often deal with things just by like going out and starting something new, which is why I've started so many businesses over the years. But ultimately, we did start a new venture, which is venture capital, but it's still very different than a single shingle business, right? Like, but the cool thing is we've also designed this business around, which is what it is that frankly I need, which is the ability to operate every day. And so like we have a truly unique model that we call operator-immersive, where every time we invest, we also step into that company very tangibly, like at least at a 20-hour per week clip, and work with the go-to-market team. Like we could be like one of our partners right now is physically the CRO for one of our portcos. We've done that others in the past. I'm working with 3 of our portcos, like literally to where you would not be able to tell our involvement from the involvement of an employee. So like I've kind of given the problem and or at least what was my solution to that problem at the same time, which is like, what am I really missing at that point, which I really had to think about, and like how do I combine what I know I want to do next, which is working with a lot of different organizations, but still fulfill that thing that frankly like makes up a decent amount of my identity.
And you said that your VC fund is operating immersive, right? But
Hmm.
and you also say that VC is not traditional VC, right? So how are you fixing? First of all, what's broken with traditional VC today?
God. Yeah. How much time do we have in this podcast? So I think there's 2 sides to venture capital, right? Like there is the portfolio company side, which is probably the side that most people think about because there's just a larger number of these folks, right? Like the companies that we invest in. I think the problem there is all you have to do is like ask the market or ask a founder like what's the issue with venture capital, and the issue that I see is squarely like VCs although they advertise that everyone has a value add, right? Very few VCs actually deploy that value add in a hands-on manner. So like a lot of the the why and the what, like what do I need to do next? Like, and this happens at board meetings all the time. Like, hey, you need to, big grand visions. You need to, what are you guys doing about AI? What's the product look like in 5 years? Or like, how are you deploying like these tools within your day-to-day operations? And then they leave, right? Like it's an idea exchange. The gap that I see in businesses with founders and early teams is not the what or the why. Like you can go online and I mean, we've all been creating content for 2 decades now at this point, telling you what and why. It's the how that is really missing. And so, yeah, that sounds great, but like, what does that look like in practice as an operator every single day? And, we found people that were doing this kind of on the engineering side in the accelerator or the boot camp court, folks that do this with banking or legal or, a lot of these like services, right? Like they can really step in and help you with a particular service. I found almost no one that was doing that on the go-to-market side. And the folks that were not doing it as a value add. You were paying in addition to or reserving some of the funds for that offering. And so that's what we do. Like we decided to fix that. I also think go-to-market is the last moat in technology because technology is ubiquitous these days. Anyone can go grab an extremely mature model online, vibe code that into a software and bring it to market in a very like in days and weeks rather than months and years. And so like even if someone has a great tech, like your competitor can knock that off and probably add more features tomorrow. So what is really setting companies apart squarely? I believe that's go to market. So that's the portfolio company side, and there's 1,000 little nuances to that. But on the investor side, and this plays into the portfolio side as well. I am an investor, and that's how I got into VC in the first place as an LP. As someone who contributes funds, I hate fund structures. I don't know how you can, number one, like you're locking up capital. The bigger funds, funds have gotten bigger and bigger. Why? It's no big secret because or firms taking fees off of those amounts. So like when you're dealing with 100, 152 million, 200 million plus fund, like the fees alone sustain an organization. They can live a very nice lifestyle just consuming fees. So that's a perverse incentive now. Like I'm incentivizing you to invest my money, but you can get fat just on bringing in the money, not even deploying it wisely. So that's a challenge. And the deployment's also a challenge. And this gets, more critical as the fund size increases as well. Like I have to deploy that capital into so many organizations, and the VC mindset is like each one of those organizations has to have the ability to return the entire fund. So what are we doing at that point? Like we're putting 10 to 20 investments out per year. And you cannot tell me you're in love with 10 to 20 companies within this environment with all the competition and just the stage and speed and qualifications that it requires on their part. There's no way you're finding like 20 awesome organizations every year and that you're like paying attention to each one of those investments. So basically you're gambling and you're saying one of these is going to pay off. It needs to pay off the entire fund. And that's what the KPIs and the math shows within venture capital, which is that, 8.5 and 10 fail. Like one tends to be like a double or a triple, and then you've got one that returns the entire fund. And like I won't even get into the nuances around IPO and public companies at this point, but like if we were basing out the last 5 years, no one's had any liquidity, and lo and behold, no one's had any liquidity. So I think that model is just really challenged across the board. The VCs I went out and talked to that I found that I really respected and whose minds was aligned with the way I was thinking are either reducing the size of their fund exponentially, or they're moving to an SPV model. And that's what we do. Like we don't have a fund. I raise on a deal by deal basis. I'm raising for 3 deals right now, as we speak. And is it a pain in the ass? Yes. Is it the best way to steward capital? Absolutely. Also, yes. And we invest in every deal that we do in addition to our LPs. So I think there's a lot to fix out there. But at the end of the day, like it all centers around like, are you being a good steward of capital, and are you providing more value than just money? Because I think there are a lot of places to get money, especially if you've got a bit of ARR out there, and something has to set those partners apart and really make them partners. So I know that was a lot, but that's my long-winded answer.
I do. I love that you have both points. traditionally VCs chase unicorns, right? That's what
Yep.
they're looking for. The
Yep.
one, extracurricular revenue, return on investment. But what you're telling me is like, why are we betting on one? Why are we not going operating immersive on a few of them and make those really good businesses, right?
Yeah, I
Like,
mean, our financial model is based on flipping that equation to its reciprocal. Like, I want to see 8.5, 9 of my 10 investments succeed, and success to us looks like singles, doubles, and triples. And like if you look at the exit data on businesses, most businesses exit before $50 million in top line ARR, and the M&A activity in that space is frothy, it's active. And so when we look for an investment, we look for optionality. Could it become the next unicorn? Absolutely. But could it also be acquired by private equity? Could it also be acquired by a strategic? We have to have that option, because the chances are so small that something goes all the way to IPO these days, and especially within vertical. There's such a market for hot, great organizations that fulfill a real need, solve a problem in the market, and then these larger organizations are looking to bolt those in, or it's something that someone else will see a lot of value in and simply take on as an asset. So um, again, our model is really based on singles, doubles, and triples, and making sure that no one's left behind there.
that's how it should be. That should be the way
I agree.
VCs, less losses, less risk, right? Less friction. More people get funded. I mean,
Yep.
that's how I feel like it should be. How
Yep.
do you decide which company or brand you back with capital and your go-to-market strategy expertise?
Yeah. So first, starting a venture capital fund in this day and age, like you have to be realistic, or at least like pragmatism is my favorite word. And so I had no misconceptions that, hey, we're a brand new VC fund with no track record. Like, we're going to see the best deal flow. Like, wasn't going to happen. And so our go to market is completely flipped from every other VC. Like, VCs are competing against each other for deal flow. We partner with VCs and we offer our value add in exchange for that. So, like, hey, yeah, you think this is a great deal? Awesome. Bring it to us. Let us take a look at it, go through our diligence process. And if we like it, provide us allocation. And in exchange for that allocation, we will step in with our go-to-market value add. And so that's where all of our deal flow comes. I mean, we do get some stuff direct to market just because we're physically there, but we've never invested in one. Like, everything has been brought by partners that we feel like are at the same mentality. They're not monster funds. Like, they're folks that are looking for the same types of deals that we are, and they see value in our value add. And so they're happy to open up. We say 1 to 3, but every one of our investments has been between 1 and 1.5 million. Like, I just need to be on a cap table roughly around 8% to make our model work. And therefore, I can take a minority share. I don't have to deal with leading and pricing, although pricing is a big qualifier for what we invest in, right? But I can count on great deals coming to us. I can truly look at each one of those and say, does it fit? Does it, meet our financial thesis, but also does the founder and their team meet our operating thesis, where we're going to be able to work with these people day to day and really do what we think is a highly valuable motion. So it's been great to step into a market. God, it's almost 3 years ago now at this point, but with no track record, and see great deal flow, be able to wake up every morning and do what we love to do, and we're starting to see results of that model. So we've already exited one of our investments. We've got 2 potential more exits now, and this is all within a 3-year clip. So I think the model is definitely trending towards proof. I think if we can get 2 more exits inside of an 18-month hold time, that will absolutely prove our thesis. And that's right, like I said, that's right on the horizon.
It's really amazing. I mean, one exit already 3 years. That's crazy big. So this company that exited is probably already making lots of money, right? Like, it was top line revenue.
Yeah, I mean, you've got to grow top line, and year over year growth has to be, impressive. I'd say, greater than 150%, and probably in that 170 plus range. But exited to a strategic, which is exactly kind of one of our points on our model. And so our entire mentality is based around, do we again, is this organization doing something that really solves a problem within that vertical market? And are there a lot of, I didn't mention, we have a big partner mentality, even in our own go to market, but certainly in the companies that we look at. Do they have the presence of a partner ecosystem or the potential for a partner ecosystem? Because quite frankly, that partner ecosystem is probably where the M&A activity is going to come from. And so if we can build, in conjunction with partners, both a go-to-market strategy as well as an integration, a technical strategy, that just gets us close to a lot of nearest neighbors that probably see value in this business. And that's what has led to all, we've got 2 term sheets on the 2 I mentioned that are our potentials. They both came from strategics within our partner ecosystem. So I think it's just kind of a no-brainer model, quite frankly.
Yeah, no, it's great, amazing. I mean, it's giving you the results that you want. How do you, so since you get your deal flow from other VCs, right, for you to actually your expertise, how do you choose which VCs to work with?
Yeah, so I mean, fund size is the big one, right? Like, are you kind of throwing everything against the wall and seeing if it sticks? So that's kind of the highest level qualifier. Second, like, do we talk the same as the other partners within that VC firm, right? Like, are they looking for optionality? What does success look like for them? Is an exit within 3 to 5 years still a win for them? And that's huge. Do they like the same types of organizations? I mentioned B2B vertical SaaS. There's a lot of nuance in there. Do they look for the same thing in founders and their teams? Do they really, try to provide some value, not just come to a board meeting and like overturn the table and be a bull in a china shop? So there's a lot of qualification that goes into that. And we don't meet someone and then just do an investment with them. Like, it's very typical for us to get deal flow from them, talk through those deals, and then maybe 6 months later, we see something that's intriguing. And but we've had enough exposure at that time to know that, like, yeah, what they're articulating is really what they're living, and our models are going to jive together. And I guess the last part would be, do you see value in what we're doing? Like, it's easy. I think it'd be easy to be like, hey, these guys are willing to work for free. I'm going to bring them like that deal that was right on the line, and maybe they'll get it over. Like, we can't be the catalyst for the reason why someone is investing in that company. Like, they have to have conviction about it already. And then, yeah, I think you guys would really be able to augment their team and maybe build that partner motion, or maybe they're struggling in a certain area where we've got expertise. So I think just alignment across the board there is the critical answer.
It's kind of like dating again. You're
Yep.
dating VCs, the same
Yep.
thing.
Absolutely.
So have you ever been brought into an organization that did a go-to-market strategy, did not work, and maybe now it's time to bring you on board and fix all of that?
No, I mean, our diligence criteria is kind of such that if something was broken, we wouldn't invest in it. Like, there has to be something of value there, right? But I would say, like, have we been brought into organizations where the people in the go-to-market team are wrong? I'll probably get in trouble for saying this, but probably 100% of the time. I find that, like, founders are just they really struggle to hire go-to-market talent. And why is that? Like, these are people that sell all day. They're really good at selling themselves. And so that, they bring someone on, they've been in the seat for 6 months, and, either they don't have any process, or they're not delivering results, or they're not strategic. Like, there's just so many, like, or they're overly operational and they can't sell. Like, it's so difficult for founders to, like, be thrown into that hiring seat across the board. And I recognize that, like, I've sat in that seat before. And so I think, augmenting with folks that have not only done this before, but done this many times before. Like, we know what doesn't work. We've done all those things. We probably have some good indications of what does work and what's right. And so we can just shorten the learning curve on experiments pretty exponentially. And so that's where we see a lot of value, is like coming in, we do some optimization, we'll build go-to-market playbooks, we might need to tweak messaging, we might do some market research. Like, anything that a go-to-market team does, we can do, like implement technology, bring in new platforms, whatever. But it's really the hiring and management area that I would say, like, if we had to carve out everything else and just do one thing that delivers hyper value, it would be hiring and management. Just showing people, like, what does a good pipeline meeting look like? How do you, diagnose that? How do you get into the weeds on that? That's where it's not just storytelling. That is definitely the area that I find is delivers outsized value.
You do conversion, right? The conversion piece is so important, because sometimes leads just stay there and they don't really move.
Yeah, and that's okay. So I won't get into a diatribe, but that's like one of the indicators. Like, someone brings up their pipelines, like 200 opportunities, and they're like, they're anywhere from 5 years old to like 5 days old. And it's like, this is not a pipeline, guys. Like, how can you run a business on this? Because owners love to, they didn't say no. Yes, but are they going to buy within, within a period that maps to your sales process? If not, they're a lead. They're out there to nurture, and you can prospect and so on. But like, just that like hyper optimistic, rose-colored glasses approach is something that, like, again, more times than not, we have to step in and say, like, nope, this is, 95% of this is garbage. Here's your pipeline. Your pipeline is what you can predict, and forecast on reliably. So like, we've got to do that. And sometimes it's just like someone else saying that with confidence. They're like, yeah, you're right. And so it's kind of that sounding board aspect that I think a lot of our founders really see, the ultimate value in.
Yeah, no, absolutely. How do you know, because you work on the whole from go to market all the way to exit, how do you know the company is ready for scaling for an exit, not just scaling for operating, scaling for exit?
Yeah, I'd say predictability is the across the board answer there, right? Like, yeah, we've seen companies that are like, oh, I delivered our best month ever, and then the next month it's like it was basically the worst month ever. It's like, no, you don't have, you don't have the right message or pricing or process or people to to really start to say, like, hey, when ingredient A goes in this side, ingredient B comes out that side. That goes for the economic model of the business. It goes for customer success. It goes for sales, marketing, everything. Like, and I say predictability, knowing that like ultimate predictability is impossible, and especially in startups. But like, you have to be able to like know which way the wind's blowing, and within a degree, an order of magnitude. Like, yeah, there's consistency here. I can predict that this is working. We can now start adding fuel to that fire rather than figuring out like, do we have the right fuel in the tank, in the first place. So for exit, I'd say that's one of the critical components. The other is just like, and I mentioned this like in the pre-show, like, does that align to what the founder and the team are aiming at? Like, what are you aiming at? Like, the answer everyone wants to, thinks VCs want to hear is, I'm going to be the next unicorn. Like, what are you building this for? Well, to get as big as it can get. It's like, all right, well, when do you know that took place? Like, that's a terrible answer. Like, you want to go think about that again and like come back to me now that I'm not just looking for the stock answer here. And I find most people just really don't consider that. Like, I don't think you have to have like written exit plan day one in the business. That would probably almost be a red flag if you did. But like, you have to know why you're building a company and like what is going to fulfill you. What are you advertising to your teams? And that's how you get people on that boat. And like, yeah, we don't, hey, we think the world's flat, but we're going to keep sailing. Like, that's what you're asking of startup and early stage talent. You're asking them to go into uncharted waters. And there has to be a joint belief about what success looks like in order to really get someone on that boat.
Yes, I agree with you 100%. And predictability is one of the things what a business is sellable for.
Mhm.
Predictable revenue, predictable cash flow. The systems need to be in place to predict that revenue, though, right? Because if they don't have like you said, they bring you a pipeline, but they don't really have a clear system of like how to get the lead, how to convert them, how do the nurturing happens, then how do we record the revenue here, how do we increase the AOV, the lifetime value, right? All of the good stuff, right? So then,
Here's the analogy around that. So like, when I sold my last business, which again, LeadMD services business, the acquirers, they wanted to know what pipeline looked like for, I think we went out the next 6 months, and they said like, all right, the next quarter, like, you can tell me that all of these accounts are going to close. And I said, no, I can't tell you that, but I can tell you we're going to hit that number. And we exceeded that number by 6% ultimately when that, and this was like, it was above quota for us. It was a great performing quota, but they were really concerned about that, right? Like, hey, you had a huge Q4 because we ultimately exited in February, and they're really concerned about Q1. Like, did you just shoot the moon and now everything's going to fall off? And I said, like, I can't tell you that every single one of those deals is going to close, but I can tell you that like, if one falls off, another one will come in and we will hit that number. And we absolutely hit the number. That's the type of predictability I'm talking about, which is like, do you have maturity across the board to where, yeah, you know that the budget that you put out there is not just something that you're going to reforecast every quarter. It's something you feel confident in, and that confidence comes from, we've got systems, we've got processes, and we do this over and over again.
yeah, exactly. Transferable, repeatable processes. I love that. Okay, so I don't agree. One thing you said I don't agree with. You said if you have an exit plan from the beginning, that would be a red flag. But for me, you need to at least be thinking about an exit.
Totally. So
It,
I mean, like, hey, I want to get to this revenue point and I'm going to sell. Like, I think the reason I say it's a red flag is, and I've seen people do this, right? Like, actually, I've got someone I know that always calls me. They're like, as soon as I get to 1.5, I'm going to exit. I'm like, number one, that's like way too early to be thinking about an exit, in my opinion. But like, what are you building this for? If you're only building it for the financial reward, I think that gets very thin over time. To your point, like, yeah, do I want to be acquired? Do I want to run this, as my lifestyle business? Do I want to merge with another organization? Do I want to take it public? Whatever those options are, like, have that goal in mind. I just believe that you can't predict every nuance to that. And again, I'll reiterate, like, if you're only building because of the financial item, I think it will be something will happen in that business to where you need to like power through something that's really, really difficult, or at least that's what I've seen. And the passion won't be there. So that's just kind of a explainer on my statement.
yeah, no, and you bring a really strong statement. I completely agree with you on that one because it's true. Think about it, but don't, and it can be flexible too. It can change too. It can take different shapes, forms, years, right? But at least know that the business is not going to die with you, right? That's one of the things that I face all the time that people think, well, I'm going to die, so I guess I don't know what about it.
Yeah, I mean, in my experience, a common question employees always want to know, and the surrounding like backroom thinking related to is like, what are we aiming at? Like, what are we trying to do? And you need to have an answer for that doesn't change all the time, because that is going to erode confidence pretty quickly. Like, I found that like employees want to know like what is happening in board meetings, what's happening with the C-suite or the exec team. Like, the more you can bring them into that insight, again, the more powerful their belief system becomes, and aligned with yours. So yeah, I mean, absolutely. Like, again, like, why are we all doing this? Like, it's one of the most difficult things to do in the world. Look at the success and failure rate of early stage companies. There has to be a pretty good reason that stitches all those people together.
Yeah, 100%. Your values, your mission, right, has to be so strong, like you said, not just money, because otherwise
Yep.
things fall back.
Yep.
Okay, this has been a great candid conversation, and I just want to end with a few personal questions for you.
Okay, great.
One habit, one super habit that you have that helps you perform at your best.
I mean, I am like natively one of the worst detail oriented people, and I force myself to be like organized to the nth degree. So like, I can't stand unread emails in my inbox. I'm a big inbox zero fan. I don't even know if that's still a thing, but it certainly used to, and I still practice and I will give an example of like how that manifests. What organizations create, and I see this so often, like, we got so many different file storage solutions out there these days, Google Drive, Box, Dropbox, whatever it is. Like, have one and have a place where everything goes. Like, the IP of business, like, I call that like the digital exhaust a business kicks off, is so powerful. Just not, be able to do something once and not have to like recreate the wheel every single time. Like, find out how you're going to store information, be religious about storing it in that way, and religious about training other people how to access that information. And with AI, this is getting so powerful. I see businesses that, like, 6 months ago, they built the same process, but like the same people aren't here. Things have changed slightly. There's no like source of truth to go back to. And so like, I've just gotten, in line with that organization thing, like, very just regimented around like everything we create has to be here. And like, if you ever work with consultants or 1099s or outside people, they love to use their own stuff, right? Like, we use an outsourced PR firm. I am absolutely religious about like that. If we write something and like the brief on this podcast, they put together a brief for me. Like, I want that in my file system, because if I ever need to call that back up, I want to know, oh yeah, I was on the Scale to Exit podcast. Here's what we talked about, so on and so forth. Like, someone else needs to know that information. So like, that just community knowledge and that tribal knowledge, really, like, you have to have a repository for it. It has to be organized, and that just goes on down the ladder. So I would say like, your asset in your business is more than what's on a spreadsheet or a financial model. It's more than what's in your product. It is everything that ties that together. And the best businesses I see are those that really have a process and a structure to say, like, if we created something, we want to know where it's at, we want to revisit it, and we want to optimize that over time.
So organization, accessibility, communication, and collaboration.
Absolutely.
Collaborative. Okay, so what is one book that shaped your entrepreneurial journey?
Oh, one single book. I hate to give a cliche answer, but I think like Art of War for me was something that got me thinking about business interactions in ways that like and I read it when I was very young and I've reread it several times. Like I think the more you can think about the give get, like the positions of strength and weaknesses, for me the main thing I took from it is like preparation is everything, right? And so if I know what you need, if I know what my value is to you, if I can provide some of that value up front and avoid an issue down the road and kind of get us together and operating, I think not even necessarily for what's in the book, but how it framed my line of thinking, I would still say Art of War.
I love that you said preparation, because you can have opportunities coming at you, but if you're not prepared, you kind of lose the opportunities coming at you. So it's really important.
And the big thing is like I think as it relates to that book is like, are we going to be friends or are we going to be enemies? Friendship and partnership and collaboration is so much more powerful. So how do I create that situation? How do I get you thinking in that manner rather than what could be adversarial? So I just think that line of thinking is again a pragmatic one for business owners.
Especially because it can bring a lot of benefit, right? As
Mm-hmm.
well.
Huge.
Everything in business. It's ridiculous how people undervalue mindset when they are in business.
All my top partners in every business I've ever created should have been my competitors, including this business. Other VCs should be my competition. How do you get, flip that script and amplify the value of both parties?
And make a collaboration.
Mm-hmm.
Yeah, a lot of people also think, competitive, like they don't want to collaborate. They just want to compete with you when there's so much opportunity in the world. Okay, and then the last one is Justin Gray. What is your exit strategy?
My exit strategy. I mean, like I will never stop working. My exit strategy in that context is, God, I would love for both of my kids to be entrepreneurs. I would love for like number one, like the road to that exit strategy is ensuring that like the people I care about, the people I love, which in that closest circle is my wife and my two kids, like they can wake up every day and have the opportunity to do what they love, to innovate and to do things that where they can bring some real value to, fill in the blank, the world, people, the people that they care about, so on and so forth. And just have that latitude. I think that's, I am a first generation, how do I say this? I'm the first one in my family that could wake up, that wakes up every day and says like, I'm doing what I want to do, not because I have to do that thing, because I need to pay bills. And that's been incredibly powerful. Like after my last exit, I retired my parents. And so again, upward mobility across the board is very critical for me because I've seen my mentality and what I was able to accomplish when all of those constraints were in place. Like I've woken up at 2 and 3 in the morning in a panic attack because I had no idea how I was going to pay that bill that was due or support myself. And I've been in a situation where you wake up and you're like, wow, this is great, and I absolutely recommend the latter. And so but there are requirements to get to that state, and there's a responsibility of being in that state. And so my exit plan would be no exit plan. I guess the immortality of planting seeds and seeing those seeds come to fruition because of the opportunities that they have is my operating plan. Yeah, and that's the challenge, right? We spent a lot of time thinking about that. Like, hey, when you don't have to, I worked construction when I was younger in high school and college. Like, if you don't have to go up and frame a roof at 100 when it's 120 degrees outside, you lose something in the fact that you have to overcome that. And so like, yeah, that's a lot of conversation with my wife and I on providing our kids not only opportunities, but those types of opportunities.
And you're right. I mean, when you are in the position of like, how do I pay a bill? How do I survive? It takes away from your creativity, your innovation. So for you to be able to come here and say, I want to give them the opportunity to not go through that, for them to continue innovating and be entrepreneurs and create legacy to, whatever way, is really powerful. That's an amazing mission.
Yeah, and I mean, I'm not saying that I have it all figured out either, right? Like, but the intentionality of saying I am going to figure this out, I think is where the focus has to be.
Yeah, absolutely. Nobody has anything to do.
That is true.
And Justin Gray, where can people find you? How can they connect with you?
Yeah, so I mean, I'm pretty much everywhere online. I'd say, LinkedIn is best. I'm always on there. One of my number one piece of advice to folks is always like, hey, reach out and ask. I'm not even saying it would be me, like whoever it is, like reach out and ask. I find that people that are in a position to share knowledge say yes far more than they say no. And I've, in my own personal journey, it's been like, hey, I'm going to take a shot and like ping this person. If the message is intelligent and like it's not just like a very surface level thing, like most times people will say yes. And so I think like that the pursuit of yes is incredibly important. But LinkedIn, for contacting me, absolutely best way to contact me. If you want to know more about what we do, or get in touch with me through In Revenue, you can also do that in Revenue.
Perfect. And I'm going to put that in the show notes as well. Do not be scared to reach out to Justin Gray. Go for the yes full. Thank you so much for joining me in this conversation, Justin Gray and Scale to Exit podcast. And for everybody that's listening, adios muchachos. Hasta la vista. Bye.